2% sounds like a fact of nature. It is not. On January 24, 2012, a committee of central bankers made 2% the official American definition of price stability. Congress had never written that number into law. Voters had never selected it on a ballot. Yet it now helps shape mortgage rates, business loans, hiring decisions, and how quickly every dollar is expected to lose purchasing. There was a vote, but it was not yours. All members of the Federal Open Market Committee supported the new statement, except one, who abstained. The real question is not whether anyone voted. It is how a technical judgment made inside a central bank became one of the most powerful rules in daily life. By the end, we will follow that number from a surprising television interview in New Zealand to the Federal Reserve in Washington. We will see who chose it, why economists defend it, what it quietly asks from households, and why reaching 2% after a price shock does not restore the prices people remember. The trail begins on April 1, 1988. New Zealand had spent years fighting high and unstable inflation. During a television interview, Finance Minister Roger Douglas announced that policy would aim for inflation around 0 or 1%. According to a later account by the Reserve Bank of New Zealand, he had not consulted officials, or apparently even his parliamentary colleagues. The statement surprised the central bank and the public. Officials then worked the rough announcement into a range from 0 to 2%. In March 1990, the finance minister and the central bank governor signed the first formal policy targets agreement. New Zealand became the first country in the modern era to place a specific inflation target at the center of monetary policy. The number did not arrive on a stone tablet. It grew from a communication strategy, economic research, and a practical allowance for measurement problems in the Consumer Price Index. The goal was to convince workers, businesses, and investors that the government would not quietly return to high inflation. That matters because inflation partly feeds on expectation. If suppliers expect higher costs, workers expect higher prices, and lenders expect weaker money, each group builds protection into contracts today. A believable target can interrupt that cycle before every price and wage has to move. Other countries opened the same door. Canada adopted a target in 1991. The United Kingdom followed in 1992. Several nations settled near 2%, even when their exact measures and accountability rules differed. The United States waited. Congress had already told the Federal Reserve to pursue maximum employment, stable prices, and moderate long-term interest rates. But the law never defined stable prices with a number. That blank space was left to the institution carrying out the mandate. For years, Federal Reserve officials debated whether naming a target would improve trust or restrict flexibility. Then came the financial crisis. Interest rates fell close to zero, unemployment surged, and the central bank discovered how difficult it could be to stimulate an economy when its usual interest rate tool had almost nowhere lower to go. Inside that setting, 2% gained another purpose. In January 2012, the Federal Open Market Committee declared that 2% inflation, measured by the Personal Consumption Expenditures Price Index, was most consistent with its legal mandate. The statement called clarity and accountability essential in a democratic society. But the democratic chain was indirect. The voting committee contains 7 Federal Reserve governors who are nominated by the president and confirmed by the Senate. It also includes the president of the New York Federal Reserve Bank and 4 other regional bank presidents who rotate through voting seats. Congress created this structure and can change it. The public elects the officials who appoint and oversee parts of it, but citizens never approved the 2% number itself. This is delegated power, not an illegal seizure of power. That distinction is important. It also leaves a legitimate accountability question. Congress chose the destination called stable prices. The central bank chose the numerical address. Now open the file marked 2%. Imagine the economy has one main dial, the overnight interest rate controlled by the Federal Reserve. That rate influences borrowing across the system. When inflation stays too high, the central bank can turn the dial upward. Credit becomes more expensive. Spending and investment tend to slow. Employers may reduce hiring. Weaker demand can take pressure off prices. When inflation is too low and a recession arrives, the bank can turn the dial downward. Loans become cheaper. Spending and investment may recover. But the dial has a flaw. Once rates approach zero, ordinary cuts become harder. This is the strongest defense of a positive inflation target. If normal inflation was zero, normal interest rates would also tend to be lower. The central bank would have less room to cut during a crisis. Mild inflation creates a cushion above deflation and gives interest rates more space to fall. Research cited by Federal Reserve officials found that risks from the zero boundary drop sharply when long-run inflation rises to around 2%. There is also a quieter labor market argument. Employers resist cutting wages in dollar terms, and workers strongly resist accepting those cuts. With modest inflation, a wage that stays flat can fall slightly after inflation without the employer reducing the number printed on the paycheck. That can help companies adjust without firing as many people, although it also means the worker loses purchasing power. The defense is serious. 2% is not random. It tries to balance the cost of slowly rising prices against the danger of deflation, frozen spending, heavier debts, and recessions that interest rate cuts cannot easily fight. But the same defense reveals who carries the cushion. At exactly 2% inflation, a basket costing $100 would cost almost $122 after 10 years. After roughly 35 years, its price would be about twice as high. That does not automatically make everyone. Wages, benefits, savings returns, and asset values can also rise. Over long periods, living standards depend more on productivity and real income than on the number of dollars attached to a purchase. But adjustment is not equal or automatic. Cash loses purchasing power. Fixed payments lose real value. Wages can lag behind a sudden price set. Borrowers with fixed-rate debt may benefit because they repay with less valuable dollars, while lenders and savers receive less purchasing power than expected. The target does not divide society neatly into winners and losers. It creates a background assumption. Contracts, pensions, rents, wages, bonds, and mortgages are written around that assumption. The real damage often appears when inflation moves far away from it, and one side cannot adjust fast enough. Now we reach the fine print most people never see. An inflation target controls the speed of price increases. It does not promise to reverse the price level. Suppose a $100 basket jumps to $120 during an inflation shock. If inflation later returns to 2%, the basket does not return to $100. It moves toward $122.40. The emergency may be over in the inflation data, while the higher price remains on the shelf. That is why official victory can feel like household defeat. Policymakers celebrate a falling inflation rate. Families remember the old total at the checkout. Both are describing real things, but they are looking at different documents. The Federal Reserve reaffirmed the 2% goal in January 2026. Its 2025 framework review examined strategy and communication, but took the target itself as given. The number survived the pandemic inflation shock without becoming the central subject of the review. Defenders would say that this durability is the point. A target only anchors expectations if governments cannot rewrite it whenever an election, recession, or debt burden makes another number convenient. Central bank independence protects long-term stability from short-term political pressure. That defense explains why elected officials should not set interest rates before every election. It does not fully answer who should define price stability for a generation. Other democracies draw the line differently. In Britain, the government sets the 2% target and the Bank of England independently chooses how to pursue it. If inflation moves too far away, the governor must write publicly to the chancellor. Independence applies to the instrument, while elected government owns the numerical goal. America gave more of that judgment to the Federal Reserve. The result may be economically reasonable. It is still a political design choice because inflation changes contracts, bargaining power, debt burdens, asset prices, and employment risk across the entire country. The verdict is not that 2% was invented to steal savings. The record does not support that claim. The verdict is more unsettling because it is ordinary. A number born from crisis management, measurement problems, and central bank research became an international convention. Congress wrote a broad command. Experts filled in the blank. The public learned the rule only after institutions had built their plans around it. 2% may be the best available compromise. It may also deserve a more visible public argument than it has received. A target with this much power should be defended as a choice, not presented as a law of nature. If you want part 2 on the alternatives, including zero inflation, a higher target, price level targeting, and nominal income targeting, comment part 2 below. Question the story, follow the money, find the truth.